Big news, the IRS just released the official 2026 tax brackets, updated after the One Big Beautiful Bill was signed. And while most people think rates are going up, the truth is more nuanced. Some thresholds got higher, the standard deduction increased, and a few popular business tax breaks just became permanent. In this video, I'll walk you through everything: what changed, what didn't, and how small business owners can plan ahead to keep more of what they earn. Let's rewind for a second. The 2017 Tax Cuts and Jobs Act, or TCJA, lowered tax rates for individuals and businesses, but those cuts were scheduled to expire after 2025. In July 2025, Congress passed the One Big Beautiful Bill, which extended and reshaped many of those expiring provisions. That means 2026 will be the first full tax year operating under the new rules, new brackets, and new inflation adjustments, making it a critical planning year for business owners. Good news first. The rates themselves didn't change. We still have 7 brackets: 10, 12, 22, 24, 32, 35, and 37%. What did change are the income thresholds. Because of inflation adjustments, each bracket now starts and ends higher. That means you can earn a bit more before moving into the next tax tier, which helps offset inflation a little. For married couples filing jointly, those thresholds roughly double. The top 37% rate kicks in only above $768,700 of taxable income. If you remember last year's numbers, that's about a $30,000 upward adjustment, which gives middle-income business owners a little breathing room. The standard deduction is what most taxpayers use instead of itemizing. For 2026, it increases to $16,100 for single filers and $32,200 for married couples filing jointly. That means the first portion of your income is automatically tax-free, even before credits and deductions. But remember, high state and local taxes or mortgage interest can still make itemizing worthwhile, which brings us to the next point. The SALT cap, the limit on state and local tax deductions, has finally moved. Under the One Big Beautiful Bill, it's now $40,400 in 2026 and will increase slightly each year until 2029. That's a meaningful change for small business owners in high-tax states like California, New York, and New Jersey. But there's still a phase-out for very high-income earners, so this helps mostly middle to upper-middle-income households. Here's a huge win for small businesses. The 20% qualified business income deduction, also called Section 199A, is now permanent. That means if you run a pass-through entity like an LLC S Corp or sole proprietorship, you can continue deducting up to 20% of your qualified profit. This change alone could save tens of thousands over time, and it's the backbone of many tax-efficient business structures. Now let's talk investments. Especially for business owners who sell assets, stocks, or even their company. Capital gains brackets are also inflation adjusted. For 2026, the 0% bracket goes up to about $49,450 for single filers and $98,900 for joint filers. This creates a window for smart planning, like realizing long-term gains in low-income years or coordinating a spouse's income to stay in the 0% or 15% zone. 2 more quick updates. First, the AMT, the parallel tax system that catches higher income filers, now exempts $90,100 for singles and phases out starting at $500,000. That means fewer middle-income entrepreneurs will trigger it. Second, the estate tax exemption climbs to $15 million per person, giving business owners more flexibility for succession and legacy planning. So what does all this mean for your business? First, reproject your 2026 tax liability. New brackets can shift your effective rate even if your profit doesn't change. Second, review your S corporation salary split. The permanent QBI deduction and higher thresholds make it worthwhile to fine-tune your reasonable compensation number. Third, consider timing. When you buy equipment, make retirement contributions or realize income because these timing decisions could save thousands. The bottom line, the 2026 tax brackets are here, and they're more favorable than many expected. Between higher thresholds, a larger standard deduction, and the permanent QBI deduction, small business owners who plan ahead can actually come out ahead. Thanks for watching. Subscribe and stay ahead of every IRS update and tax planning opportunity.